Hi everyone, and welcome to today's Insight session on Insurance in Super, the implications of the federal budget proposals. Today we've got a panel of actuaries working in different areas of the industry, pretty much across the spectrum. I'm Richard Land, I work for a super fund, Australian Super, and I'll be covering the overview and the industry reaction to the proposed changes. Also talking today will be Michael Lynn, who works for a life insurer as Senior Group Pricing Actuary, and he'll be talking about pricing and risk mitigation arising out of the federal budget changes. And finally, we have Hua Bui, who works for a consultant as partner in KPMG and the author of the paper of the federal budget impacts and unintended consequences. And she'll be running through aspects of that paper and projections and some of the methodology there. So you probably would have heard that that paper did get quite a decent amount of publicity in both media and also in the Senate Economics Committee. So just covering off on the overview, what are the changes? So the budget is proposing that insurance in super be opt-in rather than default for accounts that have balances that are below $6,000, for accounts of new members who are under 25 years old, or accounts that have not received a contribution for 13 months or longer. The key word in all that is or. So if any of those factors apply, there'll be no default insurance offered. So if only one applies. The proposal is this is all going to be up and implemented by the 1st of July 2019, and that funds will have written to members by May 2019 telling them where they might be losing default cover. And that's only a bit over 8 months away, so quite a bit of work to do. In terms of where all the proposal is at, well, as part of the budget proposal, the legislation was actually drafted and released at that time, and it has passed through the lower house of parliament. It then was referred to the Senate Economics Committee to receive feedback and submissions from the industry. And again, that's happened. And the Senate Committee has recommended that the bill be passed by the Senate. So now we're just waiting for the Senate to decide and vote on the bill and whether they will amend it in any respect or whether it will just proceed how it is. But it will be a big deal. Depending on the modelling and depending on the fund, 50% of members of accounts could lose their cover. So this is going to have a significant impact on the group insurance industry in a very short period of time. Just having a look at the backdrop and what's prompted this. Basically, it's perceived inaction by the industry to address the problems of erosion in account balances by insurance premiums, particularly for small accounts, which may be duplicate accounts across a number of superannuation funds and may also be inactive accounts. So just having a look at a few of the quotes there. So we've got the Kelly O'Dwyer one. The government is concerned that retirement savings are being eroded by insurance premiums that do not always provide value for money. And also from Choice, based on our wonderful piece, the Insurance in Super Voluntary Code of Practice. They're saying they wasted a year and come up with a compromised unenforceable code. Not my view, of course. So just moving on to the submissions, and I'll just go through some common themes. The bullet points there are issues that various different parties have raised, but it is also fair to say that there was fairly broad support for the proposals in the submissions and the feedback to the Senate Economics Committee. So there is broad thought that it will achieve the desired outcome of not eroding account balances due to premiums. I know that I was certainly in a focus group with members of a super fund, and there was a guy, and there's many cases, they did a couple of years of casual work at the end of university, and they didn't really know why their superannuation account was zero, and effectively they'd had insurance cover all that time. So just looking at a few of the common themes. The first one was don't remove cover if the account balance is less than $6,000. And this had a number of respondents making that point, including Australian Super. So the reasons for making that point are pretty much twofold. Firstly, there is a real need for cover even while the account balance is building up to $6,000. But secondly, there is significant selection risk, because by making you don't have insurance cover until your account balance is $6,000 effectively means that insurances opt in on joining. So that means that it will either increase the risk profile of the insurance business or will lead to underwriting requirements which will lead to denying of cover for many people. And I just want to quote a submission in Australian Super made by Richard Weatherhead, his wise words. There is a significant difference for adverse selection between providing automatic cover at times that the member cannot control, such as attaining age 25, and turning on cover at times the member can control, such as when the account balance reaches $6,000. So in that case, a member in poor health can simply make contributions in order to reach the $6,000 threshold and qualify for insurance cover. So obviously there's challenges in the product design to make sure that we still have a feasible and sustainable insurance offering. A second point in the feedback to the Senate Economics Committee was the period of inactivity being the 13 months. There are a number of submissions saying that in the case of parental leave, maybe that's not quite enough. You've got plenty going on in those cases and you may not get around as a high priority to rearranging your insurance in super, so you might inadvertently lose it, and that may be a time when you would really need that cover. There are a number of submissions talking about the likely premium increases as a flow-on impact from the proposals. I won't speak about that because Michael is right across that in terms of looking at the pricing impacts, and he'll go through and run through three key reasons why premiums would actually increase. And so he'll just actually run through the actuarial fundamentals there. There were submissions on hazardous occupations. So just following on from the situation where it's effectively opt-in at joining means that, again, the people in hazardous occupations may face underwriting and may be denied cover, or if they are provided with cover, they might have exclusions or significant loadings. And then there were also just about everyone arguing for a later commencement date. As I mentioned earlier, it's only 8 months since we have to start writing out to members, telling them about 50% of insured members that they'll be losing cover if it passes through the Senate. So many just argued for a later commencement date. So the Senate Economics Committee took all this in and provided their view, and they came up with just one recommendation, which a lot of us probably know. And the recommendation was that the bill be passed, presumably without amendment. And really it does follow on from the perceived inaction early on and politicians being keen that members' account balances don't get eroded by premiums. So the view is that the benefit of implementing something that addresses that more than outweighs these various different points. And then maybe the final say goes to the Grattan Institute submission on implementation, which says 11 months is not a long time, but perfectly doable. Here are some estimates for the increases in premium rates from the budget proposals. I'll just present them as they are now. From the Government Actuary to Rice Water and KPMG. In many ways, a good discussion point, a good discussion starter, I should say, and of course it will be different for every different fund. So what are insurers and funds doing right now? Well, it's certainly focused the mind. They're certainly taking it very seriously. And the most obvious one is looking at refining pricing impacts. So insurers and funds are running around furiously trying to join up in-force data files with claims files and trying to work out loss ratios for under 25 members, trying to work out loss ratios for those who haven't had a contribution in the past 13 months and trying to work out loss ratios for those with account balances less than $6,000. So data is really important, and all those requirements from SPS 250 to have the data going back many years are now very important so that you can actually assess the impacts on the various different segments. Secondly, there's some very serious thought being given to risk mitigation. I'll just give one example, but there are many. So one example is what happens on the 1st of July 2019, assuming the date stays the same through the Senate, when up to 50% or even more in some funds may lose their cover. Let's think of it from the member's point of view. A member might have had cover for 5 or 10 years, may have been paid premiums all this time, and their health might have deteriorated during that period. From the member's point of view, they're going to be stripped of cover, and if they want to retain their cover, simply what they've had all the time, they wouldn't be expected to be underwritten. They would expect to just be able to have their cover. And that seems a fair enough proposition from a reasonable point of view. From the insurer's point of view and from the pool point of view, any time when you lose 50% of your premiums and give options for 50% to effectively opt up and retain cover poses a huge selection risk. So from the insurer's point of view, that needs to be addressed somehow, and whether that be by some form of mitigation or some form of price. So there's a lot of impacts to consider, and you can go through the list of impacts being the opt-in approach or being putting in $6,000 to get cover, and there are issues throughout that, and it's really important to get these right and to address them. And the third point I raised is this is not an insignificant project. It has very significant product and operational impacts. So we need to identify and switch off cover. We need to change systems and recode them to make sure they do the correct cover and all the processes associated with having that cover. Reinstatements, lapses, all sorts of things. We need to write to affected members, and that will be significant. We need to staff up the call centre so that when you have written to 50% of members saying that they will lose their cover, there will be call centre staff there who understand and are trained to be able to explain the situation. And then finally, we will need to implement product rules, and as I said, that would also include risk mitigation measures, because on the face of it, just identifying that is probably actually the easy part, but the more difficult part is figuring out the risk mitigation and then making sure the system can cover those. So that's it from my segment. I'll now hand over to Michael, and he will talk about pricing and risk mitigation from the basic and fundamental process of how you would do that from an actuarial perspective. So thanks, Michael. And we'll take some questions at the end.
Thank you, Richard, for setting the scene and providing a summary of the market responses. There is no doubt that the proposed federal budget changes will have a significant impact to the group insurance industry in terms of volumes, risk profiles, and the future sustainability of the product. As noted in Richard's introduction, I'll be going through some of the key considerations from a pricing and risk perspective. Noting that the views and analysis here are really of the panelists here and not of the Actuaries Institute of all our employers. And I also want to quickly note that there is a kind of separate insurance in super working group currently working on a paper to be released later in the year. And that paper will look to address some of the key challenges and issues of insurance in super and the implications for actuaries. So please watch that space as well. So the proposed federal budget changes will have a material impact to the number of insured members in the superannuation system. So based on the KPMG analysis, the reduction in the number of members with cover is 50%. The impact is about 40%, but just purely based on the 6K account balance rule, 46% based on the 13-month no contribution rule, and 18% based on the under 25 rule. You can see that the sum of these numbers don't add up to 50%, as many of these members will have their cover turned off because they meet more than one of those criteria. You're probably also wondering whether this chart there is drawn into scale. And the answer is probably it's not. It's meant to be a bit closer, but it looks better that way. So I will go through the KPMG analysis very, very shortly. The actual insured membership impact will differ quite a lot fund by fund. Could be as low as 20% to as much as 80%. For example, a fund with predominantly older members and already have a contribution-based cessation of cover rule, the impact might be smaller than a super fund with predominantly younger members without that kind of cessation rule. But regardless of all that difference, I think we can all agree that the impact is quite large. So with a hard deadline of 1 July 2019, essentially what insurers and trustees are asked to do is 3 years worth of work in the 6-month time span. In terms of product redesign, potentially, repricing, renegotiation of contract, and as well as implementation. So due to the pressure on the timing, it is crucial for actuaries like ourselves to focus on the key considerations, the ones that will have the biggest pricing impact, or the ones, if we don't address it, it will expose ourselves to the biggest risk. So for this presentation, I have included 4 key considerations in dealing with the federal budget changes. So the first one, as Rich has mentioned, is relating to the cross-subsidies that's currently in place. Essentially, what we need to do is calculate the claims experience for the members that will continue to have cover going forward. And this is prior to including any experience of the members that we expect to opt in. The second pricing consideration is member engagement, which is essentially a more positive way of saying the anti-selection risk. The proposed changes will result in more members that have cover because of the opt-in offers, and as opt-out offers reduces. And as we know, all else being equal, the claims experience for opt-in members will be higher than if the insurance was offered on an automatic basis. The third consideration relates to increased claims uncertainty, which is kind of a byproduct of the first 2 items. So the sources of increased uncertainties will come from setting assumptions based on smaller data sets, usually with slightly poorer quality, changing member behavior, and as well as a larger proportion of members on higher levels of voluntary cover. And the last item is expenses. So we all know that premium will be dropping. Expenses in managing these insurance contracts may or may not drop, but it will certainly not reduce by the same amount as or the same proportion as the premiums. So there will be pricing pressure due to the increases in the real expense margins. So the remaining part of my presentation will be to go through the first 3 items, which is cross-subsidies, member engagement, and increased uncertainties. So to unwind the inherent cross-subsidies, actuaries will need to understand the claims experience for the members that will continue to have cover. To do this analysis, premiums and claims will need to be removed for the members that will have cover turned off. But for most funds, these data are not in a format that's readily available for analysis. So you have to kind of connect the member data, the claims data, and the transactional data. So RBNR will be also recalculated for the members that will continue to have cover. It is expected that these members with a contribution in the last 13 months to have a faster claims development than the members that hasn't made a contribution in the last 13 months. But all that kind of hypothesis will need to be verified and properly quantified. Other assumptions such as decline rates, IP offset assumptions for open claims, aging factors, they all need to be recalculated, as most likely will be different to the assumptions used in today's premium rates. So while simplistically speaking, you only need to calculate the claims experience for the members that will continue to have cover, it will be inevitable that you have to do the same analysis for the members that will have cover turned off, just so that you can understand the differences and make sure that your assumptions set are reasonable. So how much can we really rely on the analysis of the past based on these data? I mean, data is not going to be perfect. When you do matching exercise like these, there's bound to be claims and members who without an account balance or a date last contribution. Transactional data might only go back as far as 3 years instead of 5 years. Assumptions are now set with smaller data sets with lower credibility. And some of your active membership experience might now be affected by a few large voluntary claims. And finally, do we think there will be significant member behavioral changes that might shift the claims experience to a different level? So these are just really the typical challenges in the standard thinking process for a group pricing actuary doing a day-to-day renewal or a new business tender. But this process is probably more crucial going forward due to the extent of the changes that's being introduced as part of the budget. So we are entering an unfamiliar territory. So as Richard mentioned previously, there will be more new offers for members to opt in for cover. Opt-in offers are both opportunities for super funds and insurers to retain as much of the membership today as possible, but also introduces more anti-selection risk, and hence there will be a pricing impact. So 1 July 2019 is a date that cover will be turned off for several million members. So it is also a date that these members can take up an option and retain their cover. So hence, this opt-in offer may have a very large pricing impact purely because of the amount of members that's impacted. So of course, there are risk mitigation levers, such as limited cover provisions, risk control questions, and full underwriting. But insurers and trustees will really need to determine whether it's reasonable to have these risk mitigations in place, given that these members have full cover prior to 1 July 19. The other opt-in opportunity is at the commencement of cover. So based on the proposed changes, cover may only commence after account balance reaches 6K. So a member can technically bring forward that commencement by making voluntary contributions or roll over money funds to separate superannuation account. So one risk mitigation could be to base the commencement of cover on SG contributions only. But the question then becomes, can an administrator handle treating different contributions differently for the purpose of insurance commencement? Or will a simple at-work capability test be sufficient to manage this risk? And the third opt-in opportunity for members is when the cover ceases. And that will be an opt-in or anti-selection risk that will continue going forward. with the introduction of the 13-month no contribution rule. There will be more frequent written communications sent to members reminding them that their cover is about to cease and they have the option to retain that cover. So just to recap here, there is the 1 July 19 offer. There is the opportunity for members to bring forward the commencement of cover through voluntary contributions, and there is the option to retain their cover right before it ceases. So as noted in my previous slide, the 1 July 19 opt-in offer may have a material pricing impact, at least in that first 1 or 2 years. The cost of this opt-in offer is essentially going to be a function of what we assume the take-up rate to be, the relative claims experience, and the strength of the risk mitigation, if we decide to have any. So the chart on the left is meant to show that the claims experience is expected to be very adverse if the take-up rate is low, as only some of the unhealthy members might take up the option. As the take-up rate increases, there will be more premium to dilute the unfavorable experience. Also, having risk mitigation might have a downward impact on the claims experience as well. And the chart on the right illustrates the impact to the overall premium if the chart on the left was used as the pricing assumptions. The key takeout here is, while promoting the take-up of opt-in offer may have a pricing impact, if the marketing campaign was really successful and the take-up rate is very high, then it may reduce the amount of pricing increase that's needed. But these charts are all just for illustration purposes, so each insurer will need to utilize their own opt-in offers and past data to calibrate these curves. So there will be more uncertainty for the group insurance industry going forward, and that's just not us actuaries being conservative here. So make sure your key stakeholders know that there is more uncertainty going forward. The three sources of additional uncertainties are essentially additional assumptions based on smaller data sets, higher proportion of voluntary cover or high proportion of cover that's kind of non-default, and there's uncertainty regarding member behavior. So if we believe that the claims distribution today is that blue curve over there, then most likely after the budget change, it will look like the dotted red curve that looks a bit flatter. So while we could reprice so that the average loss ratio going forward is back to the original level, there will be a wider distribution of claims outcomes. So for any insurance contract with an asymmetric risk-sharing model, the expected return based on the black distribution versus the blue distribution will be actually very different. And it is up to the insurer to determine whether and how the additional uncertainty needs to be captured and addressed. Although we do expect some of the volatility to normalize over time. So to recap, the three considerations, or the four considerations I've talked about, it was the cross-subsidies, member engagement, increase in claims uncertainties, and also expenses, which I've touched on the earlier slides. So just ending my part of the presentation with a metaphor from a previous insight session, I think presented 2 years ago. 2013 was the TPD crisis, which brought a lot of fear to the market. But the insurance industry as a whole survived. In 2015 and 16, insurers' profitability was restored. But also, it was a time that greater level of scrutiny was brought into the industry. And that level of scrutiny continued in 2017 and 2018. So I thought to myself, what could be an appropriate representation of the group insurance market post 1 July 2019? And I thought of this gentleman there. So there will be more volatility, and we're not sure what's going to happen next, but there are opportunities, and it's certainly not the end of the world. So on that note, I'll pass it on to Hua. she will go through the KPMG analysis and unintended consequences. Thanks.
Hello everyone. It's very hard to top that last picture, but so it could be a little bit drier in the next few minutes. So thank you for the opportunity to co-present. I just want to acknowledge my co-author, Ed Tam, who is sitting at the front row here. He does a lot of the modelling, and also his knowledge of superannuation funds pricing are invaluable for the paper. And this paper I wrote with a superannuation expert from KPMG as well. So it's not just my work, it's a teamwork. But all comments today are my personal views and not necessarily one of a KPMG. Okay. So first of all, I'm not sure how many people have read the original paper, but I just thought it'd be useful to understand what we set out to do. So about in September last year, we set out to build a model of the existing level of default cover in Australia. So we built a model that is meant to represent quite a lot of information on the current system. So we're not worried about whose benefit has been eroded in the past. We're only looking at what we end up today in 2017 based on publicly available information. And we're not, so what it is not, we are not trying to take a member and project them to retirement and come back. So it's not a lifetime model. And so that has implication when you interpret what it's telling you, right? That's the first point. The second point is we've used a range of sources, and they're all publicly available data, both from a bottom-up and top-down. So the information that we use from the bottom-up are things like the ATO sample data set, where you can see individual people with salary and ages and so on. So that gives us a realistic profile by gender and size of the salary and so on. We also look at the upper stats, which gives you a distribution of cover by fund, by age and gender. We look at the publicly available cover by age and the premium rate that comes with them. And we look at the census to look at participation rates. So what we found is that none of those sources by itself will give you the full picture, and it was necessary to infer relationships between age, gender, salary, cover, duplication level, and so on. I think Ed will say it wasn't a simple exercise. But we ended up with a model point file that is based on the information from the top 12 public and industry fund that represent over 75% of members who have default insurance in super. So not all members, not all cover, but the default part of it. And when the budget measure came out, we updated that model. So a couple of things I want to talk about before I go to the budget impact. It's important to share the key finding of that original report, because it's kind of relevant to then understanding the impact. So the very first slide I want to share is just simply pushing the two bits of information together from two different sources, and they're very reliable sources. One is the ATO. The ATO has, through the tax file number system, can match everyone's superannuation fund and put them together. So they can tell how many people have total account balance, you know, what their size is. In other words, if you look at the ATO can tell you that only 5% of members have less than 1,000 account balance in total. But if you look at that same stat, but for the number of accounts, there are 30% of accounts which is less than 1,000, which means that a lot of those accounts are duplicate. And so that's a really important fact that was referred to in the Senate, in the Productivity Commission paper, and that is a point that we still disagree with that paper comment on our paper. They said that what we have assumed is not realistic, but it is realistic because these two facts, when you put them together, suggest that the duplication is at that low end. Anyway, for us, it wasn't an easy inference. You actually need to sit and think about what the two distributions mean together. The second point I wanted to share is that the paper had two key findings at a high level. One is that overall, the cost of insurance in super, which is default, costs on average 6.2% of the retirement balances. So it wasn't exorbitant on average. But I think the point is not the average. The point is that we need to understand which segment of the population was actually unfairly hit by the insurance in super being default, which is what Richard was saying before. And that picture, to me, tells the story. It was always postulated that younger members are hard hit. But if you look at that picture, I've graphed the erosion of benefits by age and also income level. If you earn 37 to 87,000 of salary, the impact can never be more than 20%. But if you earn lower than 18,000, impact is enormous. And those are, we believe, the biggest, hardest hit segment in the community that needs to be protected. The low salary earners, not the account balance, not gender, because women are up there because their salary doesn't increase over time, and that's why they're hardest hit. So our conclusion after the first paper is that the group, sure, there is some impact on age and account balance and so on, but the biggest group that needs protection is the low salary earners. And if you remember the three buckets that Richard mentioned, none of them are low salary earners. So when we updated the paper, our conclusions have fallen into four buckets. How many people would be impacted? And I think you've heard enough from the first two speakers to realize that everybody thinks a huge number of people are impacted. You're talking millions of people. This is like out of 14 million working Australians, 7 million would lose cover unless they write into their super fund and say, no, I don't want to lose the cover. So it's a massive impact. Secondly, what is going to happen to premium volume? Thirdly, what does that mean to premium rates? And then are there any other consequences? I think Michael covered this first point really well, so I won't repeat it, but basically a lot of the impact would come from taking cover away from inactive accounts. So people who hasn't contributed for the last 13 months. Typically when people think of that, they think of people who have taken time off work, mothers who are not contributing. But in fact, a lot of people are in that bucket simply because they haven't consolidated their super. And I have been doing that, for 10 of my last 20 years is I've had some money in different super funds. So it is actually not uncommon, and it's more than just the people who take time off work. Surprisingly, the people who are under age 25 is only, doesn't account for that many people who lose cover. So it's not just the young people that are impacted, it's everyone. Most people in this room probably be impacted in some way if you have more super in more than one place. So then we looked at what would happen to premium volume. That follows pretty quickly. If you lose 50% of your members, then you also lose a lot of your premium volume. And this is actually not that hard to model once you've got the model the first time, is to simply remove cover, like Michael said, right? So I want to spend a bit of time on the impact because it's a lot less clear, a lot more judgment involved. Well, basically, we had to make some assumptions about how many people would opt in, how many people, and what the level of mortality and morbidity that they would experience. We also need to form a view of what kind of people would do that, what kind of cross-subsidy would be removed, and that's not an assumption because the cross-subsidy is existing, and we know that from the first model. So that is not an assumption at all. If you remove that, the certain people, then the cross-subsidy is removed. Generally speaking, you would be increasing the average age of the fund, so you expect that that would put up the price. So the three key driver of premium increase, in our view, are the removal of cross-subsidy that exists currently, either by age or between inactive and active members. Secondly, we expect to have a low opt-in rate because in the past, whenever you offer people cover, and it's not compulsory, even members who need it don't opt in. So let's take health insurance. Health insurance is a perfect example. People can buy health insurance, but they don't buy it. And look what happened. The people who need the cover, so the people who are, age 65 and over, all buy it, and the people who don't need it, the healthy people stay out. So why would that be different here? We also consider what kind of extra mortality and morbidity they would get. And again, we don't have the exact replica, but we have lots of examples of it. When voluntary cover is given, who opt in and what kind of mortality, morbidity experience do you expect? Also, when people leave company and they offer to have to keep their cover, generally you see a significant, like multiple times morbidity and mortality experience in those. So, our assumption doesn't replicate any of those, but it is in that ballpark. And we think that realistically, I'm not expecting after the budget change that people would suddenly become hugely more engaged than they are now. Possibly a little bit, but not a huge amount. And that's probably one of the biggest difference between some of the costing that are out there in the market and ours. And we'll be very frank, I'm not expecting that. If we do get much higher member engagement, that would be a great outcome. But we haven't factored that in. And so if you do that, then and there is a third impact, which is expense. Expenses are not all variable, as Michael pointed out. In fact, after I listened to Richard and Michael, I think we have to do a lot more work than we did before. So expenses level probably doesn't fall. Even though some of them are variable, you probably have to do a lot more work to maintain the same service. So we have factored in 50%. That 50% of the expenses would be variable and 50% are fixed, and so the fixed part will stay. Even if you lose your actual premium income, you still have to pay for that expenses. And so to maintain a reasonable level of profitability, we expect that premium will go up quite significantly, mostly from the less than 6,000 balance, but also from the inactive members. As Richard and Michael both said, the impact will very much vary by fund, and it will depend on the three factors that I mentioned before, which is how engaged are people and how much anti-selection do you get, how much people opt in. The higher the level of opt-in, the lower you expect the anti-selection to be, but I'm expecting some. How much cross-subsidy does your current fund have, and also to what extent can you reduce expenses when your premium income falls? And you'll find that different funds will have different experience. The other comment I'd like to make is, what would this do, what would the budget measure do to the level of benefit erosion? So if you didn't have any premium increases, then yes, the people who do have cover, they would have a bit less erosion. But if you do factor in the premium increases, then I think it'll be, quite a significant increase, 1% from 6.2 to 7.3. Now, I don't want to overemphasize the 6.2 and the 7.3 and so on, because they are averages. And as I said before, this analysis is about the people who are adversely affected. So it's really about the segmentation result. It's not about the average result. For me, the more important question is, does the proposal actually achieve what they set out to achieve, what the government set out to achieve? Now, I assume that the objective is to reduce the erosion of benefits while still giving the people who want cover the cover. So then let's look at that then. Firstly, for the people who get their default cover removed completely and they never opt in again, then obviously they don't have any erosion of benefits. But the point of insurance is not that you don't have to pay anything, but that you have the cover when you need it. And based on our track record in the population of people having to induce to buy insurance, having financial planners explaining to you why you need it and so on, that is the plus, but I think that's also, there's the loss of benefits there for the people who never opt in again. For the people who are opting in, they would have higher costs because there's no longer, I say this, there's no longer any cross-subsidy from the people who claim less than themselves. That's a positive, I guess. But this proposal never addressed the low-income earners, and it never addresses the people who are most affected, who are not going to be less than 6,000 in account balance, and who are not going to be young or inactive. They are still the hardest hit because our premium continue to be expressed as a dollar amount and not a percentage of salary. So what are some of the buts that comes with the proposal? The biggest but that I'm concerned about in the short term is that some people will think that they have cover and then discover that shortly after the cut-off date that they don't have cover. And then that would put both the trustee and the insurance company in a really difficult position given the recent discussions about customer focus and customer rights and so on. So that's a really big risk, I think. And it's a risk for the whole community, not just the trustee or the insurer. Overall, we would have significantly less insurance coverage. And while I think, young actors who are 10 and who worked, they don't need cover, they shouldn't have cover. But overall, as a community, we would have less insurance cover. And as Richard and Michael said, there is significant work to be done between now and the end of June of 2019, and there is significant operational risk involved with implementing this, particularly considering many large super funds are administered by basically two of the key administrators. So they have to do all the work, and all the work is going to be different for every fund, and it affects like millions and millions of Australians. How am I going for time? I think I'll stop here and give us a chance to take questions. Now, I have to do something special for this now. Okay, so this is the first time we are trialing this, so people who are on the webinar can actually type in questions and we can see it. We've never tried it at the Institute before, so let's see how it goes. We can also take questions from the floor.
Yeah, so we will certainly welcome comments and feedback, any questions. So people have presumably given it a lot of thought. There's going to be a lot of people here impacted in terms of workload, etc. So what are the thoughts? What's the feedback? Do you agree with Hwa's comment on the salary? Any questions for the panel, please? Yes.
What are your considerations with relation to like communication strategy for members who have lost their account cover, especially for like the 13-month rule?
So basically, okay, so first of all, there's a lot of requirements for that in the Code of Practice. So I think you'll find a lot of super funds are already working on that. So if you have a look in the Code of Practice, when you lose cover, and there is proposals in the Code of Practice to lose cover, not as severe as the budget, there is proposal to write to them at the end of 6 months, 9 months and 13 months when they actually lose cover. So a lot of that is in train with the code. So although the budget is a lot stronger than the code will still apply. So there will be all those correspondence points on an ongoing basis. But I think it is a challenge. I think you've raised that it is a real challenge in terms of when you're switching off cover, because that's going to be the big one. And I think it is important to have it on various different levels, and the levels being the basic information being provided by the funds, be it the significant event notices, being it all the correspondence and the letters to the members impacted. And I think it's also the challenge to have all the other areas of information and advice all lined up, so that, as we said before, just a challenge for the call centre to have enough people for that period to actually ask questions. So we project that there will be a significant spike in inquiries and that they will need information on that. And then the wider requirement, of course, is to tap into your advisor network, be that a fund's own advisor network, or be that independent financial advisors, to make sure that if members do need advice as well as just information, then they have access to that. So that's how I see as a broad spectrum of the issues impacted. Did you have any further thoughts on that?
Well, my thoughts were more with regards, I guess, when the member's actually making a claim and they don't know that their cover's been switched off. I think there's like a lot of reputational risks attached to that. So like, how are funds going to tackle that issue?
So all I can say is that I agree with you. And there's also issues depending on the risk mitigants too, because a lot of that all coordinates depending on how you plan to tackle those sort of things. So whether you're planning to have pre-existing conditions excluded if you opt in, for example, or under certain circumstances. So I agree that that's important at the claims phase too, because a lot of those risk mitigants on the way in aren't actually tested until the way out, such as the active employment test, those sort of things. They're all tested at claims time. So all I can do without offering a solution is agree.
Thanks for the presentation. I mean, this is an extraordinarily complex area and is going to be a huge risk for the industry going forward from here. We've talked quite a bit about the potential for anti-selection from opt-in. But I think the KPMG material has been quite fascinating, because when you get down at this area of lack of contributions, under $6,000 payments, to a degree the age one as well, a lot of the issue is not around, is the difference between the number of accounts and the number of members. Because this is where the duplication of accounts all sits, is down at this area here. And one of our dilemmas is, how do we actually analyse this? If you're looking at an individual scheme, you can't see all the multiple accounts that a member might have. You're looking at a member picture. And it may well be that people here already have cover somewhere else in an active account, and the loss of this insurance will be of no consequence at all. And the lack of engagement will make this area very, very complex. And it'll also mean that there's potentially going to be far less opt-in, which is exactly what you were suggesting, I think, for all of this, than might otherwise occur because of the nature of these multiple accounts. And that means that the premium increase then is likely to be at the higher end rather than lower for those that are coming along. That's just my feeling about it at the moment.
Thank you for that comment, Dennis. I think as I was doing the analysis, it dawns on me that the real issue is actually the duplication of account. If everyone just have one account, a lot of these would, half of it would go away, right? So that's the first thing. But there's an unwillingness for the ATO to do that role. So we actually went to the ATO and said, we need this information, you know, can you provide it? And you know, can you let the fund, we actually have a discussion about, can you let the fund know the other funds that this same member is on, so they can do the right thing by their members? Because at the moment, the fund, as you exactly say, is hamstrung on how much they know. But that information isn't forthcoming. So there's something else in the system that I think is much more fundamental than just the insurance in super issue, the duplication issue. If we solve that, we don't need to solve this other one, because 90% of it goes away. It's a very, very good observation. Thank you.
So, hi, just following up on that, do you feel the other part of the budget proposal of consolidating accounts will help to solve that problem on its own?
I think it will solve most of it. It doesn't solve the really young members who just come in and only do 10 hours of work. So your children who go to Woolworths and do 10 hours, that won't solve it. So some of this is necessary, but the scale of it is, and the blanket nature of the 6,000, I think, is an issue. You sit and think about what it means, which I'm sure all the super fund have by now. It poses a lot of complications that are possibly unnecessary, but consolidation of account is actually a much more, a much simpler way to solve a lot of it.
So,
I have a question for Michael.
Yep.
While we're waiting for questions to come in. Oh, we do have. I'll hold my question to look at this question, right?
Okay.
We have a question that comes on. Can you go back to the slide of accounts versus individual? Yeah. Can you go back? Can everybody see the question? So I don't need to read it out. Can the people on the webinar see it? They can. Okay.
I think it was why. No, better go back to the question. Just
So that's the slide. Why are there more members
then accounts in the hierarchy.
than account? These are proportions. Yeah, they're not the number of members, they are proportions. Yeah, so does that answer the question?
So my question is, basically to mitigate anti-selection risk, insurance companies might do some underwriting, and in that case, do insurance company has right to decline some options, or they might just vary their rates depending on underwriting, or they just give same rate for all the members?
I think if it's full underwriting or some kind of risk control questions, then the purpose is to say no to some of the applications. Yeah, so the insurer will have the right if it is full underwriting.
What about for the members who currently have cover and they drop out? I don't think you can decline. Can you decline them? Hello. Yeah. So for the members at July where they lose cover, where they can opt back in, I'm not too sure you can decline those members who currently have cover.
That's probably something to consider, I think, for insurers. Yeah, definitely there will be reputational issues.
Yeah.
Look, thanks. Phil Patterson from Willis Towers Watson. Thank you to all three of you for the presentation. Just a couple of questions. Why you indicated that obviously a key assumption in there is, what is the additional mortality and morbidity assumption of the anti-selection, and having read the government actuaries report, which has a sort of plus 100 in there, are you able to share the sort of assumptions that you thought was reasonable in that case?
I haven't read the government actuaries report, but our assumption is higher. Our assumption was 200. And continuation option, I think you could see up to 300% extra mortality, so plus 200. So our assumptions probably sit in between the normal and the continuation option. Yeah.
Okay, a question for Richard. Obviously Australian Super, and I appreciate you're relatively new to Australian Super, but Australian Super have led the way a little bit here with the under 25 rules. Did Australian Super see a pricing impact from that?
Not from the under 25s, but you would have seen in the presentation there that the under 25s is probably the lesser of the cohort of all of those three. And the other point to note in the under 25s for Australian Super relates to new members, not existing members. And that's the same for the budget changes as well. So that's probably the least of the impacts of all those.
Just quickly adding on to that point, the under 25s impact will really depend on kind of the existing premium rate shape and whether there's cross subsidies in the current premium rates, really.
Yeah, look, I absolutely agree. And last question for you, Michael. I guess since 2013 in particular, we've seen a much higher prevalence of limited cover under various circumstances as I guess a risk mitigation factor. From an insurer's perspective, have you seen that as being effective as a risk mitigator, and sort of do you see it as I guess a potential solution for these changes?
I think from a pure kind of risk mitigation, we are seeing declines of claims due to the limited cover provisions, and for some funds it could be quite material. Whether or not it's considered effective, it really whether we're thinking it from kind of pure numbers or pricing perspective, or from whether it's the right thing to do. So I think if pricing is a key consideration, then limited cover is a lever that could be used to maintain that risk here. Yeah.
There's a question. Is there a trend in group insurance to remove the age default voluntary cross-subsidy anyway? So maybe a question for Richard to start with.
Certainly that's a trend which is occurring, and you would have seen Hester recently remove some of their age cross subsidies. That was one of the larger ones in the market. I know at Australian Super there has been a bigger emphasis on removing cross subsidies, and that's actually part of our insurance management framework to try to minimise or remove cross subsidies. So it certainly is something that's occurring in the industry, and the ones who have made decent progress on that will certainly have a lesser impact from the budget changes than those who haven't.
And Michael, do you see that as in your pricing too, that there's a trend?
Quite interesting actually. When I first started in group insurance, there was a trend where we started charging everyone the same premium rates, whether you're like default or voluntary. Historically, it's actually quite different for voluntary and default in group insurance, and now I think we are seeing that there is a focus to really, firstly, to understand the experience difference between default and voluntary. Whether or not we're seeing actually charging them different premium rates, I mean, at the moment, we're not. Personally, I haven't seen too many funds charging them differently, but I think there is a stronger focus to understand the experience in more detail.
Okay. Maybe I can get to my question to Richard, to Michael now. In your presentation, you talked about some of the risk mitigation and their effectiveness. Maybe can you share some of the risk mitigation measures that you would consider, given that the budget measure is going to be implemented? Yep. So assuming that they would be implemented, what are some of the things that we can do?
So one of them that Phil kind of raised previously is the limits of cover provisions that we could use. For example, at say the commencement of cover, where if a member say makes voluntary contributions to commence insurance, you could have some kind of limits of cover provisions on those kind of commencement. Other ones will be we'll probably have to think about this one a bit more.
Yeah.
Essentially, it's really a fine balance between making the cover hard for people to claim on or pricing impact. So.
Yeah.
Yeah, but I mean, basically, it's almost like an actual exam question, isn't it? What are the risk mitigants? And we know the ones that are out there. There's also short form underwriting, and there's also being at work or being able to work when you start.
Yeah.
So they're what they are. And at the end of the day, there's probably no right answer, is there? And it is the answer that the trustees need to answer, but with advice from the likes of us. So I think it'll be really important. And I also see probably the risk mitigation and the product design is more important than the pricing.
Yep. You mentioned in your one of your answers, Richard, that people may not have at work requirement when they come back in, but I was just thinking, why not? Why couldn't we have, because people are always going to come in and out of cover, given the changes, why couldn't we just have at work requirement when they come back in?
So you're saying on the changeover date?
Yeah.
Yeah.
But also after, because the criteria is age, 6,000 and inactive.
Yep.
And other than age, we're always getting older. The other two, it can cut in and out many times over your working life.
Sorry, which ones cuts in and out?
So you're inactive. You can be inactive, then you'll be active and inactive again. So it's multiple entry.
Yeah, so the one example that I was giving was more on the changeover date.
Yeah.
But those ones you certainly could consider risk mitigation tools like that, and they would be quite effective. And even on the changeover date, you could implement those, but it comes down to, fairness and also seeing it from the member point of view and what the trustee is willing to do and where they sit on the spectrum of sustainability and price versus, fairness to members and the ones actually impacted.
Yeah.
This is
Daniel?
a general question to, I guess, the group and see where it goes. It's relating to the cross-subsidy again, but it does seem like the biggest impact will be for funds that have a large cross-subsidy by age. I guess it's more of a principal discussion of how do the actuarial community, I guess, allow such practices where people were effectively having unfair insurance premiums at a young age, or and potentially at an old age it does so too. And this has now come, and we've found that erosion of account balance is such a prominent aspect. So how do we avoid these kind of things in the future? Examples, male and female. We also know there's an insurance cross-subsidy there. Should we be looking at that? Voluntary, non-voluntary. There's also an occupation type adjustments that are necessary. So is it a point where we should almost pull the band-aid off and really do a bit more risk pricing rather than following a more, let's say, pragmatic approach? So that's my thought.
I'll start and then I'll ask Richard and Michael for their view. I think the product design and also the design of the shape of the premium charge is often a trustee call, not the insurer's call. I know in my pricing days, often we would recommend a structure and the trustee might say, oh, it's too complicated, we can't cope with, age-related and also gender differential rates. So I think that's still the case. A trustee has to decide what's right for their members. So the answer to your question is we need to work with the trustee to get them. I mean, now they understand the issue. It'll be less challenging. But back in the days when they first have they have the full right to decide what product design to have for their members. Actuaries can recommend, but we can't make the call.
I guess should we have been lobbying them better, I guess, than
I think
giving them full awareness.
I think it's really interesting, and I don't know if I necessarily have a firm view about where I sit. So in a way, it goes to the whole philosophical debate about group insurance versus retail. So in group insurance, to be able to provide blanket cover very cheaply so that basically 75–80% of premiums across the industry go back to members by way of claims, we are actually relying on a decent amount of disengaged members. They'll just take whatever the default is. And over time we've seen that chipped away. So during the disability claims crisis we certainly saw selection. Now in here that's chipping away at that a little bit as well. So we're saying that we're going to remove part of the blanket and almost half the blanket maybe in some cases. So it's sort of chipping away at that, and it's also going to have opt-in, which gets it a little bit closer to retail. So the point that you make about cross subsidies, then you go to all the other cross subsidies that are in retail but which are not in group. And by moving to remove those cross subsidies, you get a little bit more towards retail. And a lot of the submissions to the the Senate Economics Committee are in relation to high-risk workers and saying, well, this is a really good thing about superannuation. It provides social benefits in that high-risk employees can get members. But as we gradually make it more and more opt-in, there's probably less and less chance that those members will be able to get cover, and if they do get cover, get it at the right rates. So it's a double-edged sword. Yes, why should, for example, some segments of the membership be subsidising others? But on the other hand, there is some powerful social good which comes out of it. So, look, I don't have strong views either way. I do think that over time, as insurers and funds look for a competitive advantage and we're getting better at data analysis, I reckon it will naturally find its way towards more individual rating, and it will naturally cause some of the problems for the high-risk sector, etc. But I think it's a really interesting thing, and whether it's a good thing or a bad thing, well, it just depends.
And also that goes to the low salary earners as well. So again, it's a social good that low salary earners could get some cover at the moment.
Yeah, just to sort of, I guess, comment on the history of all of this. Absolutely, it's the trustees that have driven the design, and I've spent many years trying to argue with trustees about cross-subsidies and different things, and there's a lot of inertia there. And some of it's history. A lot of these industry funds in particular have had dollar per week scales that were originally designed back in the 1980s, and the demographic changes since then have naturally changed things. So there's a lot of inertia there. But to Richard's point, the great strength of group insurance, and insurance in general, insurance relies on cross subsidies. So where that balance is along that, I guess, spectrum of, one rate for all, gender specific, age specific, occupation specific, is a matter for judgment. And the trustees do try and make that judgment, and they're certainly being forced now to do that, with these changes too. But it will certainly be those with, particularly under 25s, I think, and who haven't addressed that will be hardest hit.
Thank you, guys. This is Gary from Aon Benfield. My question is around really forward-looking, right? So we have the danger of having 50% of the default cover being removed, but we still have 50%, right? But then you look at history, 2013, we faced the huge amount of uncertainty in the TPD space, and we passed through a lot of the large rate increases followed by a lot of large reductions, right? And Michael made a comment around the industry is being under increased scrutiny because of that, right? So my worry and looking forward, how do we avoid this situation so that the 50% remaining default won't be removed? Because the thing is, when we face uncertainty, again, we put in margins as actuaries, right? Because we don't know what to expect. And then if you don't actually hit the right level, and given data is a problem, given ATO, we can't probably access the multiple account stuff, right? So how do we, as an industry, right, come together and come to the media or the government to make sure that we don't, 5 years later, sitting here and talking about another budget change because of what we've been through have been through in the last 5 years. Now the whole default insurance in superannuation is removed.
So ultimately I see it as the responses from the individual participants, because we are in a competitive environment, and I think it's, apart from the likes of a code of conduct, for example, I think the pricing and the things that, and risk mitigation that you're alluding to is being done in a competitive environment. And I would look back to the disability crisis, and that was an example of market disruption. And whenever market disruption occurs, there's winners and losers. And I think you would have seen some of the participants in the winners and losers in the life companies during that particular time. And I was working in the consulting industry at the time, and I saw different responses to that. Some were consultative and measured, and others were less so, and imposed increases. So all I would say is that this is another big disruption. I don't think in a competitive environment, apart from being very diligent as a profession in the code of conduct and deciding what's right thing to do, I don't think we're going to come up with a joint sort of approach to look down. But I think there is the onus on a number of us to really focus on what's the right thing. And I know there's a real balance. There's a right thing for members. There's a right thing for claimants, a right thing for the pool of members, a right thing for the sustainability of all the entities. And so there's no easy answer, but I think it'll depend on the, how the individual participants react to market disruption. All right, unless there's any last burning question, we might call it quits and let you get back for your 2 o'clock meetings. Thank you.